ServiceNow lifted its fiscal 2026 Now Assist AI target to $1.5 billion. They already booked $750 million by quarter end. The stock still sold off about 15% after the print. Here is what the numbers actually say. ServiceNow is enterprise workflow software for large companies worldwide. The first quarter of 2026 was a beat on revenue and adjusted earnings per share. Management raised full-year subscription revenue guidance again. Traders focused on geopolitical deal timing and acquisition margin math instead. 5 lines matter most this quarter. Total revenue was about $3.77 billion. That beat pre-print consensus near $3.75 billion. Adjusted diluted earnings per share was 97 cents. The street sat near 95 cents. Full-year subscription revenue guidance was raised for fiscal 2026. Armies adds growth with disclosed margin trade-offs. GAAP gross margin was 75%. That is down 400 basis points year over year on acquisition amortization. That row is a watch item, not a miss. Non-GAAP operating margin was 32%. That expanded 100 basis points year over year. Total remaining performance obligations hit $27.7 billion. Growth was 25% year over year. That is forward revenue visibility, not just one quarter. Now Assist AI annual contract value reached $750 million at quarter end. The fiscal 2026 target is now $1.5 billion. Customers spending $1 million or more on AI attach grew over 130% year over year. Management quantified a Middle East headwind near 75 basis points on subscription growth. Large on-premise deals slipped because of regional conflict. They called the drag temporary and bounded. At Analyst Day, they raised the Now Assist target from $1 billion to $1.5 billion. They outlined a $30 billion subscription path by 2030. They returned over $2 billion to shareholders in buybacks this quarter. Vesa and Armis widened security with near-term margin noise they spelled out in the guide. 3 reasons to stay constructive. 1. Every key line beat the street on revenue and adjusted earnings per share. Full-year subscription guidance moved up. Non-GAAP operating margin expanded to 32%. 2. Now Assist AI contract value is scaling fast toward a $1.5 billion fiscal target. Analyst Day reinforced a long-term subscription framework, not a walkback. 3. Most covering analysts remain constructive after the print. Several firms maintained or raised price targets after the sell-off. 3 reasons to stay careful. 1. GAAP gross margin fell 400 basis points year over year. Integration amortization must prove temporary, not structural. 2. Middle East deal timing and armies mix add real headwinds this year. Management embedded both in the outlook. 3. The stock is still far below year-to-date highs. Enterprise software multiples can retest lows on any softness in backlog or AI ramp. My signal is, buy with medium-high conviction on a 3 to 12-month horizon. ServiceNow beat consensus, raised subscription guidance, and lifted the Now Assist target after a 15% post-print drop. The sell-off looks like Overshoot on quantified temporary headwinds. The next catalyst is second quarter earnings around July 22, 2026. Watch now. Assist contract value march from $750 million toward $1.5 billion. This video is for informational purposes only and is not financial advice. Analysis is based on ServiceNow's public earnings release dated April 22, 2026. Wall Street consensus estimates were sourced from Yahoo Finance, Zacks, and MarketBeat articles retrieved on May 16, 2026. Always do your own research before making investment decisions.